Good evening. You want to find your seats. We do like to start things on time here. And it is 5:59, so count me early. But and there's plenty of food out back. At least I think there's plenty of food. I have not been through the line, but you may, if you want to get up at any point in time in the evening to get more food, please do that. Drinks are back here in the center. Restrooms are straight out these doors to my right, your left, and on the left, men's and women's. So if you need those, you can step out at any point in time. So want to start, I'm Howard Halderman with the Halderman Companies. Certainly appreciate your attendance tonight. We are offering a virtual option, and it looks like we have a fair number of names here on my screen. So we've got some folks watching virtually. We have an event tomorrow in Winchester, like this, Winchester on the other side of the state. I said, oh, we can just do it virtual the whole way. And wouldn't you know, farmers say, well, no, we'll come to the seminar because we can't haul grain. So why not go to the, slog through the snow and go to the seminar? I'm actually going to zoom in for that one. I didn't think driving across multiple counties they're all, emergency red might be a great idea. But anyway, hopefully the snow is relatively light and not impactful. We've got a great lineup for you tonight. After me, it gets a lot better. We'll have Chris Shulman with New Line Law. He'll be talking about solar leasing. And Chris and I had an experience a few years ago. He represented a very large solar developer on the big project up in Placer County. So you want to talk about an attorney who has actually represented a large project and worked on that. Chris is the guy. So if you have questions about solar leasing, also probably can speak on some wind as well. He would be a great one to ask those, not necessarily me, especially on the legal side. And then after that, I'll turn it over to Chad Lanham. And Chad is Chief Financial Officer, Senior Financial Officer here in the Lafayette area. And Chad's got a presentation from Farm Credit. And then there's a whole host of Farm Credit folks here that with you this evening. So not only can you buy farms here tonight, but you can also finance your farms and get your legal side covered as well. So it's a one-stop shop this evening. So with that, I'm going to start and we'll be talking on farmland values and very dynamic market, right? I will bring you sale results from just the last, week that we've experienced. So farm real estate trends. The question you might have is in 2023, which direction are we going to head? We know where the market's been. We'll discuss that here pretty quickly. Halderman Companies. My grandfather started the business in 1930. He's the one there in the middle. We represent farmland owners, not always farm operators, but farm operators tend to be owners as well. So we do appraisals, we do farm management, and we do farm real estate brokerage. So if you own farmland, we can help you out. And you can see some of the statistics there. Over 240 million sales last year, 1,200 appraisals, and also do some farm management on 40 million acres. And the point on this slide would be our staff, many of which are back here to my right. We have John Beckman in Lafayette. We've got Josh Weinbach up in Wolcott, Nolan Sampson, Director of Business Development out of the Report area, Jim Clark out of Frankfurt, Gary Bolander out of Darlington, and then Sam Clark back here, also out of our Frankfurt office. You might look at them and say, yeah, some of them have been with you a few years and some maybe more than a few years. Sam or Jim and Gary and I are going to make this average of 20 years because we'll be on the long side of that, and Sam and Nolan and Josh will be and John will be on the younger side. But we bring a lot of experience, is my point. So if you have any questions about your area or south of town, north of town, I can direct you to whomever you need to talk to. They're the ones that know your area really well about rents, farmland values, those sorts of things. Can't miss that one. Here's the states that we work in today. We're going to talk about Indiana, which is most important, I think, to all of you. But if in fact you want to talk about some other crops or other states, we can get into that as needed. So farmland values certainly have been strengthening. We'll get into 23 here in a few minutes. But we're going to start with where the market has been. Few outside drivers of sales. Outside driver would be a tax law change. It might be a farm bill change. It might be something that isn't necessarily pertaining to production agriculture that would cause a landowner to want to sell. Fall of 2012, we had the threat of capital gains tax going up because we knew Mr. Obama was going to be reelected. We had a Democratic Congress, so the thought was capital gains taxes might go up. They never did. But with the fear of those going up, we had a lot of sales in the fall of 12. That would be an example of an outside driver. And honestly, from 2013 through 2020, the volume of sales on the market was below normal. Didn't have any of those kind of outside drivers. In the fall of 21, so we're out of the pandemic, so to speak, and you start to see commodity prices increase. Chinese demand, phase one of the trade agreement is impacting that. And you start to see a little better farm incomes. And we saw the volume of sales increase in the fall of 21 back to what I would call more normal. Then it kind of slowed down last spring, but picked up again this fall, especially the fourth quarter. And I don't know if you looked at the fourth quarter. Typically, we'll sell 5, 6 farms after Thanksgiving, and we had 20. So it was a really busy fourth quarter. And we have a fair number of sales here in the first quarter of 23, but I think a lot of this real estate marketing year, which tends to go from harvest to planting, maybe was a little front loaded in terms of volume. But we have seen that volume return to more normal numbers. And question mark, I had this discussion with one of my staff today, are we going to see as many auctions as we did last year? I kind of don't think so, but we're at the all-time high of farmland values. So if somebody's thinking about, well, I want to maybe exit the farm in the next 2 to 3 years, and you're at the all-time high today, and interest rates have gone up, and who knows about commodity prices, maybe I will sell today versus waiting 2 or 3 years. So those are the kind of decisions some folks are making. If you're an owner of farmland like I am, and you have no intent to sell, well, then the market just moves. But cropland values were stable 2016 through 21. And we've seen them jump up quite significantly. 30% would be the Chicago Fed number. I would argue is higher than that, 40+%. We're at the all-time high of farmland values. A little later, I'll talk about farm incomes. This is inflation adjusted. So 2013 was the previous high. We just got back to that in the last 6 months when you factor in inflation. Recreational, timberland, rural residential values all increased due to higher incomes, full employment, COVID, demographic shift a little bit. People saying, well, maybe I don't want to live in densely populated areas. Maybe I would like to live in the country. And oh, by the way, I can work from home. So you saw some of that changing a little bit that caused folks to want to own some pieces of land out in the country. That segment of the market does track the general economy. So if in fact we see some recessionary trends, I'm not calling a recession, I'm just saying if we saw some downturn in the economy, maybe an uptick in unemployment, you could see those values reflected negatively sooner than what you would in farmland, typically. Here is our USDA cropland values, and you can see that this is a much smoother line than what you're going to see when you get more localized. These are all values across the United States. All cropland, not pasture land, rangeland, etc. But you see the uptick over there of $320 an acre increase from 20 to 21. That would be a little less than a 10% increase, but that's across the whole country. What that will tell you when you compare it to what Indiana or the Corn Belt has done, there's some other parts of the country that haven't increased nearly as much. California would be an example where they haven't experienced those increases. Almond prices are not super special right now, and they have a lot of water issues. Some of that's getting resolved, but still, they're going to have long-term water issues. So you're not seeing the appreciation like we see in the Corn Belt across all of the country. Now we'll get a little closer to home. This is the Chicago Federal Reserve Bank, 7th District. They publish an ag letter every quarter. This was the most recent, back November to November. You can see the I states are on the left-hand side of those bars. Anywhere, Illinois up 20%, Indiana up 29%, and Iowa up 22%. That's year over year. It doesn't include the increase that we saw before November of 21. But pretty strong values, and the whole district up 20%. Here's the Purdue survey. So we started at a high level of all of the U.S. Yes, sir.
What makes Indiana so special?
Back on this slide.
Yeah.
The ag bankers contribute to this.
They do?
Yes, so this is the Chicago Federal Reserve Bank. These would be FDIC insured banks, not farm credit. So I'm not pointing the finger at any of our farm credit folks in here. But your FDIC insured banks are submitting their opinions. So it's an opinion survey that they're turning into the Chicago Fed. And then this is factored into. So when they ask all the ag bankers in Indiana, this was their conclusion. Michigan shows no report. So either they got 2 or 3 people turning them in, and that wasn't enough to call it a representative sample, or they didn't have any reports. Because Michigan certainly went up. It was not a 0. So you got to take this for what it's worth. But it's a survey and it's ag bankers. We're not special in this. I think Iowa and Illinois went up probably more than we did. So here's the Purdue survey. I would say this is a little more accurate. So there are some farm credit folks, farm credit appraisers that contribute to this. Halderman staff contributes to this. Farm brokers, farm managers, and appraisers from around the state contribute to this. And you can see the big hockey move up here at the far right-hand side that would represent the increase. This is June 22. That's when they do the survey. They publish it in August, but the survey is done in June. So last summer, these were values, and then that's $12,750 an acre. I would venture a guess, if you own farmland in this part of the state, none of you would sell it for $12,750 an acre. We sold 2 farms last night in LaPorte County, both for $15,000. So if you have a high quality farm, $12,750 is not the top of the market, but it's the highest that we've had in the survey. Again, this is a survey, this is an opinion, and when I fill it out, I'm going to be a little more conservative than maybe what the market actually is. But it does reflect the all-time high values. Here's the actual Halderman sales. So now we've gotten really specific because these are actual sales data. So different than the last 3 things I showed you, those were opinions. These are factual sale data. And each little point on here, up and down, are individual sales. So I take this back to 21 because I want to show you the jump. And we do this, I need an explanation. So we take the sale price of a farm and we divide it by the productivity index of the soils on that farm. You can map every field in the state of Indiana and you can map its soils and it will give you an average productivity index for that field. And it's a great way to, compare this field in Clinton County to another one in Warren County and come up with a relative production comparison. So one in Clinton County might have 165 bushel WAPI, weighted average productivity index, and one in Warren County might have a 135. Odds are that Clinton County farm is going to be significantly better than the Warren County farm, assuming average drainage, fertility, and some other things. So what we do is we take the sale price divided by that productivity index, and we arrive at so many dollars per corn bushel of productivity index. And the market for many, many years, 2016 through 2020, traded right at 50, which if you drew a line right through here, it would be at the $50. So the first half of 21, we traded at 55. The second half, we traded at 80. And it was like a light switch. August 1st, we had five sales in 7 days in late August, and they were all over $10,000 an acre. And I said, something in this market has changed. And it had. And you can see the sales the rest of the year were up substantially. So here's numerically how it looked. First 6 months of the year, our average sale price was $55 per bushel of productivity index. Second half, it was 79.81. So that's a 36% increase. I had 30 earlier, but I told you I had sale data that might prove it to be a little higher. Our average in 21 was $51, average in 21 was $71. The 22 average was $85. So the market continued to move up pretty significantly into 2022. Another way to look at it is sales over $10,000 per acre. First 6 months, we had 17% of our sales in 21 at over $10,000 an acre. 88% in the second 6 months. That's a big jump. You go back to 2019 and 2020, we sold farms over $10,000 an acre. That wasn't necessarily a new landmark, but they were lower than 10% of each year. Here's the 22 data, all the way through the end of the year. And you can see a little bit, this gives you clued into when the marketing season is. Here's quarter one. And the wider the gap between Q1 and Q2, that's more sales volume. Then you see it get really narrow during planting season, Q2, June, or May, June, July, or April, May, June. And so that really was a pretty small sale sample for us. Q3 a little bit bigger, and then Q4 was the biggest one. And that's what I said, we had a lot of sales. But you see the trend line hung right at $85 all the way across. Pretty good average. Now here's the way it looks when you put 2016 through 2022. And this really accentuates the big change that we experienced. If you go back to 2016, all the way through half of 21, $50 was the number. Year after year after year, I do these presentations, it was $50 again, $50 again. And then boom, look at the jump on the far right. So here's a whole series of sales. If you want this slide deck, I'm happy to share it with you. I'm not going to talk about each of these individual sales. You can kind of look through them real quickly. What I want to show is that there's a wide range. You know, you still get stuff at $43 a Wabi point. Now this was down in Daviess County. Some of it was flood impacted. So if you have something that floods, it's not going to sell for the top of the market. That kind of makes sense. Could have very good soils. So your soil Wabi could be fairly high, but it's not going to bring that price because of the risk. Here's location factor, $19,000, almost $20,000 an acre. It's Hamilton County. So that's not necessarily a surprise either. So we'll go through these fairly quickly. And we get, here's this second quarter, and you can see just a few sales all the way to July. And then we get into August. Some of our appraisers have thought, see if it holds true, that maybe the third quarter, maybe September was the high of the market. And then we saw a little weakness because interest rates continued to increase. Not sure that's going to prove out, but we had a sale here in Whitley County at $14,002. That was $104 per corn bushel productivity. That's an average farm, 138 bushel productivity index. In Indiana, you range from under 100 to about 185 on the high end. So 140 is average. This was slightly below average. We've been managing the farm, so we kind of knew it. That 104, that's a really strong sale in our opinion. But there are a lot of other sales that are of similar values and similar values per Wabi. There's Rush County, 19,000 an acre, 113. So we're coming into November, lots of sales volume at this point, and there's one or two per slide under 10,000. Now a little weaker into December to some degree. You see some 60s, you see a 40. And we closed the year fairly strong here in Tippecanoe County at 102 per Wabi, 15.6. Fayette County at 98, and then Hancock County at 65. That seemed a little cheap. And I guess that's something Artie Schrader and I spoke at the Top Farmer Workshop 2-3 weeks ago. And one of the points I made at the Top Farmer Workshop is the fourth quarter. Third quarter was really strong. Fourth quarter, what we still saw some high numbers, like this 15.6 here in Tippecanoe County, $102. But we saw more volatility. So we had some sales come in here, this Hancock County, that just seemed cheap at 65. So it's still almost $11,000 an acre. So it's relative, but it's kind of interesting. Now, look at what happened here in the last 2 weeks. All three of these are over $100. This one's closer to 115. I didn't do the productivity index because it was 80 acres of woods in that. And it sold for $15,000 an acre. So I'm not here standing and telling you the market's getting weaker in 23, because I have no evidence of that. We have 2 sales tomorrow and 2 on Thursday, all online auctions. So we'll get more data here fairly quickly. But so far, the market's fairly strong, and that's Rush and LaPorte County, arguably 2 of the better counties in the state on the average. So you can follow our sales on our app if you wish. Download it either Apple or Android. Who are the buyers? Last year, it was 55% farmer, 45% farmland investor. And I want to be clear, farmland investor means somebody probably lives here in Lafayette. Probably has another job, but they want to own farmland as part of their portfolio. The institutional investors, they participated in the market. They bid, but they aren't the winners, and they haven't been for 2 or 3 years. Their expected rate of return they're seeking for right now is higher than where the market is. We'll talk about cap rate here in a few minutes. But what that means is the buyers are going to tend to be the farmer down the road or a farmland investor from that local community who's willing to accept a little lower rate of return because they're buying a piece of land in an area where they want it. But you can see historically the farmer is the majority buyer. These are our actual sales. This isn't the whole market. When you factor into the whole market, I've got that slide here in a second, it's a higher percentage. Because you have a lot of these transactions that Halderman's not involved in. They're off-market tenant buying from landlord, and that's a farmer buyer. So you see the percentage jump up to 71%. And I think if you look at data out of Iowa State or Illinois, when they ask this question, 75, 80% farmer buyer tends to be the number. So Natasha and I were at an event last week up in Minneapolis, and we had a couple from here in town along on that trip, and she had attended one of our auctions in Montgomery County, and she started asking me, aren't the Chinese just buying up everything? I said, not farmland. Yeah, they bought some piece in North Dakota, or they were trying to, but it was relatively small, and I have not ever in my career sold any land to anybody related to a Russian entity or a Chinese entity. And in fact, in the state of Indiana, we now have a law signed by Governor Holcomb last April. And if you are foreign to the United States, you cannot buy cropland in Indiana. Most people cheer that. Yeah. I'm not a fan of the legislation personally. They allowed a loophole. They said if you're associated with livestock, you can buy as many acres as you want. And I said to my state senator and state representative, same meeting, I said, so who owns Smithfield Foods? Oh, we don't know. So the Chinese. So you're allowing them to buy as many acres as they want through Smithfield, in theory. They haven't, but in theory they could. So it's got some gas. But that was passed, and that Indiana has a foreign ownership ban at this point. So before you get worried about the Chinese buying, they're not. I will dispel that rumor right off the bat. Here's the ag barometer. Jim Minchard does a really good job presenting on this. This is kind of interesting. It's an opinion survey, 400 producers from across the country. They ask them how they feel about agriculture. Are you optimistic? Are you making future investments, capital investments, that kind of thing? And it tends to kind of reflect where the attitudes are. This got up to 174 back here coming out of the pandemic. Higher commodity prices due to this phase 1 trade agreement, and then just things kind of eroded. Well, when you ask the questions why, it was, well, we can't get equipment, so supply chain issues. Input prices are up significantly, and now interest rates start going up. But I think this jump up to 126 in December is probably reflective of the all-time record farm income year in the history of the United States, or close to 1973. For those of you that were around in 1973, that was the other banner year. Believe it or not, when you adjust for inflation, 73 and 22, best years ever. So I think that farm income probably started to resonate with some folks and saying, really 7% interest is not historically high. It's higher than where we were, but it's not historically high. So something to watch. Will inflation be a factor? It certainly has been. Farmland is positively correlated to inflation. 1-to-1 correlation, meaning we get into inflationary times, farmland tends to appreciate. There are other assets that do that. Gold would be another example. But you can see elevated inflation, which is probably where we were. If this is 22, we should be, remember that USDA price? $4,420 an acre. So if that was 22, 4,400 would be upwards in here. So farmland has actually responded even more favorably to inflationary times than what projected were by Moody's and USDA. So inflation is a factor in what farmland values have done. Don't miss it. Interest rates, low interest rates were a factor before. Higher commodity prices, farm incomes are certainly the biggest factor, but inflation is in there. And here's where I said that we're above the all-time high. This is 2013. All these are nominal values, and then you can see on a nominal basis, we're definitely at all-time high farmland values. But when you even factor in inflation, we are back above 2013 at this point in time. So if you're kind of a Warren Buffett buy low, sell high, this is that sell high moment. And I bring that up because we have had some sellers this fall say, hey, it's the all-time high, and I was going to sell in the next couple of years, might as well do it now. So that has been a factor in why people sell. It's not because they've been financially forced to. Who does the financing out here? And you're in good hands because these folks from Farm Credit do about half, believe it or not, of the financing in farm real estate debt. This is the whole country back in 21. Commercial banks, 31%, and then you see the host of others. So talking about debt, when you factor in inflation, we're back at or above the all-time high back here in 1980. That could be scary, right? Because some of us remember the 1980s. In fact, real estate debt is significantly above the real estate debt that existed in 1980. Couple of points on this. One, asset values are up substantially higher than what they were then. So I'll show you the debt to asset ratio. It's pretty low. The other thing would be real estate debt tends to be what kind of mortgage? Long term. What about interest rate? Fixed. So long term and fixed rates. So when you think back to these times, there were a lot more variable rates and interest rates were double digits. So we can see this is all at fixed rate, not all, but a high percentage fixed rate, or at least fixed for a long period of time. And we can experience interest rates going up substantially, but it's not going to have a huge impact on interest expense because those are fixed in. So a different structure to the debt than what we had back then. Here's the farm debt segregated. You can just see the different way to look at it, but non-real estate actually has been dwindling. This would be equipment, operating lines, and then your real estate debt. I think structurally that's a safer place to be. The other thing that I found interesting, Iowa State did a survey 2 or 3 years ago now, and did anybody know what percent of Iowa farmland has zero debt? I want to throw out a number? 50? What'd you say? 70? It's 80. 80% of the farms in Iowa have no debt. So when you think, oh gosh, that means the other 20% probably have a fairly high level. Probably do. But I don't think Iowa is a lot different than Indiana and Illinois. Pretty consistent across the corn belts. We have a lot of land ownership that has a very high cash equity position. So I'm structurally not hugely worried about our debt situation. Here's the average fixed interest rate. This is a little lagging. We're up higher than that. You're probably closer to 7% today. So, higher than what we were in 19, but not a lot. So it wasn't that long ago that we were back at these levels, and certainly nothing comparing to the 1980s. And here's how that factors in. Interest expense is this red line, and you can see back in the 1980s with the variable rate interest instruments out there, it almost matched the debt. Today, it's moved up some, but not nearly what the debt level has. So I think that's really one of the things is keeping the interest expense down. Now, Iowa State, I keep referring to them, but when Dong Shang did a study, he came out and said he thinks interest rate impact in agriculture is probably not until this fall. That would be your operating lines starting to come due then, and your interest rate, higher interest rate on your operating lines maybe being a factor, having to pay that bill, and you start to have maybe your new farmland purchases at higher interest rates. So your interest expense really probably doesn't come home to roost as quickly in ag as it does in the housing market, which is almost an immediate response. Here's the solvency ratios, debt to asset, debt to equity, very low levels. As I said earlier, the asset values are pretty high. Debt to income, the ability to repay your debt. So debt divided by income, $1 million of debt, and you make $250,000 net income, that's a 4-to-1 ratio. And you can see right now we're at 3-1. The study will tell you over 5.5, which I don't know why that's blurry, but somewhere right in here at 5.5, that becomes a warning sign, which is where we were back. This is 1976, right in here, and we went way above it, where debt was really outpacing incomes. We've been on a pretty downward slope the last 5 or 6 years. We were above 5.5 in 2016 or 17, and it started to become concerning, but then we trended downward. Farm repayment loan rates above 100 is positive. They're paying it back as they should be. And the number of farm loans delinquent, very low, 1.5%. So from a debt standpoint, we're in a pretty good position today. So where do values go from here? I kind of hinted at this. It depends on these 3 things: incomes, interest rates, and supply. We've talked about them. Farm incomes, we'll get into in a second. Interest rates, higher, but not super high historically. Supply is back to more normal times. Incomes, we have that golden era of cash generation from 07 to 13. Then we saw a decline. And from 14 to 19, that was a cash drain to some operations. We're break even throughout that time period. And I really think, if you think of my WAPI chart and that flat line at 50, we stayed at that flat line at 50 in spite of declining farm incomes because there wasn't an abundance of farms for sale, and interest rates didn't change a lot. Government support started to kick in 18 through 20. That was the MFP, market facilitation payments, and then you have the COVID payments on top of that. That really shored up a lot of income statements. Interest rates increasing rapidly, and then farms for sale more the typical 2%. So here's the net farm income picture. And I mentioned that this was the best year ever. And I did hear a report that when you inflation adjusted, it's 1973 is the other best year. And you can see that we are well above at 187.9, and this just came out in December. So this is their most current estimate of farm income, both net cash, and you can kind of see the net farm income is the bottom line and net cash income is above. So very, very good year. Here's another thing that I thought was a very interesting chart. These guys at Ag Insights did this. Go back from 1973, look at how high that farm income was. And I tell you, that was a pretty good year. And 22 is not on here yet, but 22 is going to be at 180. So 73 and 22. But my point on this is we used to average roughly $85 billion of net farm income through the 80s, 90s, and early 2000s. And then we started the ethanol and Chinese demand, and you jumped to 110. Point would be, as we go forward, when you look at net farm income, 90 is not all that special anymore. One might argue with today's input costs that 110 is not that great. So I think we're at a different level now in terms of what we need to expect. Cash rent expectations, this is a little hard to read, but green is 0 to up 5%, gray is up 5 to 10, and red is 10% or more. Point is that from June to August last year, that kind of dwindled a little bit in terms of expectations of going up a lot, and that was due to input prices, but that probably has changed within farm incomes. I mentioned government program payments being very significant in terms of the income statement back in 18, 19, and 20, especially 2020, all-time high. This is inflation adjusted, folks. All-time high government program payments all the way back to 1970. So they were a significant part of making it work. If we had not had them, look at what real net cash farm income would have done. Folks can see that. That's a pretty big decline if we had not had the government support that we did back in those days. Renewable diesel. Okay, you say, Howard, that's random. You go from government program payments to renewable diesel. It is. But it was an interesting chart. Soybean, when I think about soybeans for most of my career, it was all about the meal, what we're feeding our livestock. All of a sudden, oil has become the story in the last couple of years. If, in fact, we continue to switch the airline fleet over to renewable diesel, this really becomes a story. In theory, and I want to point out this is just a hypothetical, you could make the argument that if we switch every plane over to renewable diesel, it takes every soybean acre we've got. That's not realistic. So I wouldn't put a lot of stock in that just yet. Then I read a report yesterday morning. You know, China had a rule, one kid, for a long period of time, right? They announced this year their population declined for the first time in decades. The projection is that's going to continue for quite some period of time, where China is not going to be the biggest, India will be. And so if you, and this was really a very negative report, but basically saying Chinese demand is going to drop because they're not going to have as many people. That's the summary of a multi-page article. I think it all kind of averages out, but this could be a real reason to plant soybeans. It's all long term, and it's going to take a while. But this is real. New renewable diesel is having an impact on the market. I thought the impact of trade, this is kind of interesting. You think back to the phase 1 trade agreement, we went from $28 billion sold to China to 36. That's a big impact from the trade agreement, right? They did a good job. What was interesting to me, it was mostly in corn and beef. Soybeans, almost a negligible increase. Corn and beef were really the most benefited the most from that. And then fertilizer, we've heard a lot about fertilizer prices. Those have actually been trending down, but that's a pretty high percentage of net farm income at 22 and 20%. Timber values still moving stronger. This is going to turn as the housing market turns. And that's been happening over the last 4, 5, 6 months. Cap rate. And why is this important? When your CDs at 3.5%, 4% are more than or double what your return on your farmland is, there are some folks that might make a different investment decision. So we talked about 45% of our buyers being investors on that previous slide. Will they make a little different decision if this cap rate remains closer to 2? The point is, you've got other institutional buyers that will buy at 3.5. They're not in the market today, as I said earlier. So this cap rate, in fact, I've got a client in Denmark. I sent him some projected budgets, and he was giving me a hard time. He said that isn't right. Values have gone up double, and the rents have not. That's not the way it should be. Soren, that's the market. I'm not making this stuff up. But he's looking at it from a financial perspective and saying that doesn't match. So, you know, how do we impact this cap rate? It'll either be cash rents going up or land values staying flat or going down. I think that does jump up this June. So cash rents and results, and I want to make sure stay simple on schedule. Got about 8 minutes. So our staff, I did a survey back in September of where they thought cash rents would go. Quick summary of this. Yes, we were going to see, expecting some demand, higher rents. We had some bid out, and they were, range of increase was 47 up $136 per acre. The market makes the rents. We don't. And what we found this fall is that there's pretty good farm incomes, and that leads to a little more pressure on rents upward. And demand was up, supply was down. Summarize that slide real quick. Do we have any tenants in distress? Yes, one of our guys had a tenant in distress. So while I talk about all these rosy things, there are some financial struggles out there once in a while. And then we use a lot of cash flex leasing. It's a great tool. It has kind of a steady, guaranteed flex or guaranteed cash rent year over year, moves a little bit up or down. And then if you get a really good year like last year, there's a big bonus payment paid. But the bonus is where it's 25 cents or 33 cents of every dollar over a certain profit hurdle. So the farmers keep a majority of those dollars. And so it's kind of a win-win situation, and it ends up being a nice way to lease farms where you mitigate some risk for the tenant, and the tenant pays a bonus if it's a good year, and there's a mechanism for how that bonus is determined as opposed to it being arbitrary. Base gross revenues are a factor in that. That's the profit hurdle. So basically means at 11 or 10.50 an acre in corn, that's the highest I've ever seen as a base gross revenue number. Every dollar over that is somehow split with the landowner. And we calculate that with the local cash price times the actual yield on the farm. Here's the rent survey. So to my client from Denmark's argument, land values went up all that, but rents didn't. That's not right. Well, they didn't. Remember the land value chart and how it moved up to about in here, but rents only went back to the all-time high. Again, I think when the survey's done this June, that'll be a different calculation. I think we'll see rents jump up quite a bit and land values a little less so. Both increase, but rents probably more than values. So we'll get into the forecast and wrap this up. So as you think about owning farmland, we'll talk about more bullish factors than bearish because I'm bullish at this point in time. But first of all, you have this long-term world demand fundamentals. Argentina, it didn't rain for a number of weeks, and they keep declining their crop production. Why do our soybean and corn prices go up? It's a just-in-time delivery world that we are in. And that's how Argentine weather impacts our prices up here in the dead of winter. So we got to have more food, and oh, by the way, you got renewable diesel. You've got a lot of arguments that are positive for the demand for our commodities. Interest rates are up. The 7th district, they reported 6.13% mortgage rates. That's 15-year fixed money. That's up 2% from the lowest ever. So it's higher, but again, not historically high. Supply of farms picked up last fall. Government support, not much in 22, and I wouldn't expect much in 23. We're in a farm bill year. Supposed to have one in 23. I was at a Farm Foundation meeting 2 weeks ago, and I will tell you the experts that have lived through this. If you listen to the current Secretary of Agriculture, Mr. Bill Sack, oh yeah, we're going to get it done this year. If you listen to the people that have actually worked on it, they said no shot, it'll be 24. So I would look at some kind of 1-year renewal or extension of the current bill. I think the next bill will probably look very similar to what we have now, because a lot of people like it. Farm Bureau's behind it, so we kind of like the way that it functions. So I think that's probably the way it shakes out. Obviously, different numbers probably. Input costs and the break even is much higher. So that's the inflation factor here. I don't know what your break even is on corn and soybeans, but it used to be just below $4 2 years ago. Now is it 5, plus or minus? So when you start thinking about corn prices out there, and you say, well, that's $5.50, that's probably still profitable for most folks, but you're starting to get pretty narrow margins then. So the break even's up quite a bit, and record incomes equal more cash. That was really the theme from the Top Farmer Workshop: liquidity, cash that exists out there in the marketplace, and that's really what's spurring on a lot of the land values moving up. Crop values are certainly in an uptrend. You know, timber recreational land, steady to weaker. They're more interest rate sensitive, more generally economic sensitive. So I think steady is the way I would call those. Shoot, we may go through this and not really have much of a recession at all. And unemployment remains really low. And I think as long as people have jobs and are making some money, they probably continue to invest in recreational land. When Purdue did their survey and they published it, I did an interview with Indiana Agri-News, and she asked me what was surprising about their report. And I said, not the cropland values. In fact, I think they're a little light. What was surprising to me was the value of recreational land. The survey said $9,000 an acre for land that you hunt, you fish, and ride four-wheelers on. I thought that was high. I wouldn't pay that for it. Thought it was high. This average to below average farmland, Hassel Farms, just be careful. And with today's big equipment, 80 acres and 5 fields, that's probably not going to sell anywhere close to an 80-acre rectangular field. Same soils. I'm bullish for these reasons. You had a lot of money made last year, profitable prices even yet today. Low amount of debt to assets in agriculture, moderate supply of farms for sale. Biofuels, the RFS was renewed for the next couple of years, basically where it was. That's positive, I think. Got population growth, trade deals have certainly helped. Inflation is supportive, and water resources. We have a lot of good water resources here. The West is getting fixed a little bit with the snowfall that's happened out there, but they're a long way from being where they need to be. If you want to be bearish, if you want to make a bearish argument, you could. Yeah, what's the effects of the pandemic? Is China shut back down? We've been opening up. What's the weather impact? Obviously, you see that in Argentina, or the market went down a lot yesterday. Why? Because it was raining in Argentina and Brazil. So those certainly have immediate impact. Our and global production increases. High prices do cure high prices because it stimulates production around the world. And you've seen that. You could have the worldwide economy tank, recession. A lot of folks have called for that. So these are some reasons that you really just kind of watch. I'm not there today. I think the farmland market's steady to up 5% this year. But you've got some issues that could be some headwinds as we go forward, depending on where corn and soybean prices go. So let's say, just throw out a hypothetical, 450 corn this fall with another 50 basis points on interest rates. Could I make an argument for land values going down 5 to 10% come then? Yeah, maybe. If you think back to 2014 and 2015, land values went down 15 to 20%. Why? Because we had break-even pricing. Not so much interest rates, but the farm incomes dropped. You've got these other asset classes, so we talked about that. Working capital concerns, not really a big issue right now. Bullish fundamentals. So, like I said, market steady, up 0 to 5%. Our group, back in September through March, they were calling it stronger on farmland and kind of that steady to a little weaker on residential lots and recreational land. So, with that, questions?
Yep.
Yes, sir.
So the one thing you totally skip over and you don't mention at all is you don't put a map up there, Google map of the United States and small and medium-sized cities and how they're encroaching on a huge amount of farmland. Why doesn't that go into calculations of what value of farmland is? Because we're losing it at an exponential rate, not just here, but everywhere. But there's whole documentaries on this. You can look at it. And you said there's still a lot of farmland out there, and people will be able to produce enough crops for the population, but that's not really true if you look at what's happening to available land and where it's disappearing. Let's look at Tippecanoe County. I don't care if you go south, north, east, or west. There's new developments everywhere, and that all used to be farmland when I first moved here. That's gone. That's no longer available. How come they don't make a big deal about that when it comes to investing in the farmland? Farmland is literally disappearing. It's not like they're making more of it. That seems to be a big issue. Number two is the people that are like institutional investors in farmland. Do they actually end up getting money from the government for these government support programs? Or does that just go to the farmer, not trickle down to the institutional investors? How's that work?
It is not, because most of them earn more than $900,000 a year.
And so that just cuts them off.
They're out of that, so they're going to structure a lease where the farmer gets it.
A couple others.
So you're right. There are a lot of acres that go out of production for houses every year for development. It's not a super high percentage in the total scheme of things. And
I think the Netflix special would argue with you on that, but that's okay.
I would imagine, what is it? The American Farmland Trust would argue with me too. I've got some good friends that run American Farmland Trust. It's not a huge factor in terms of consumption of acres, because there's a lot more acres in Brazil to be developed for cropland. Sub-Saharan Africa, there are other places in the world they can develop more acres.
You mean when they deforest more? That's what you
mean? No.
Especially in Brazil.
In Brazil, it's pasture conversion is what they're looking at now. President Lula is not a fan of deforestation. Bolsonaro was, Lula not so much. Anyway, that is a factor. Probably more so on farmland values is the 1031 exchange dollars that come out of those transactions. You think about what's happening down here in Boone County and the Lilly development and all of the things that IEDC is doing. When they buy up land like that and those folks then redeploy that has more of an impact on farmland values than the acres that are being taken out of farmland do today. I'm not saying that you're wrong long term. I'm just saying that in the current market on an annual basis, we don't see a huge impact by the climate. Because when you look at the acres, they're projecting a higher 92 million acres of corn for this year. That's up from 88 or 89 last year. So we are producing more acres, or at least remaining pretty consistent in our acreage production when you talk about millions of acres of corn and soybeans. So it's not having an appreciable impact there yet. But certainly the 1031 dollars did.
And I used to live in Boone County. And I can tell you where I used to live, all the farmland is gone. I've been down there, and especially, on the, if you're heading up I-65 on the left side, all this development, and I have friends who own farmland there, and it's being taken by eminent domain, and they're getting kicked out. And they're not getting current value of the farmland, I can tell you that. And I know these people personally, but I've seen that whole area just decimated, all that farmland is gone. I suppose I'm more worried about that than most people are.
Well, I will always be a private property rights advocate. So if somebody wants to lease their land for solar, Chris, they can lease their land for solar. If they want to sell it for $100,000 an acre for a development, I'm not going to tell them they can't. So that's me. You can have a different opinion. It's a free country, right? Other questions?
The average amount of farmland that turns over as a percentage of total acres in the state of Indiana every year and changes hands.
Cells?
2%.
Yeah, it's around that 1.5% to 2%. It's a very low percentage. Yeah, and that's kind of what has been interesting in the solar debate in Wabash County. We have a solar developer that wants to come, and there was a debate about, solar goes in, that takes this land out of production, right? And it's 2,000 acres is the maximum they can do there. And then they said, well, gosh, that's not even 2 or 3% of the overall land in Wabash County. So they got less concerned then, because it was a $200 million investment for a county that's declining in population. It's not Tippecanoe County. Most of your counties in Indiana are in declining population situations. They're not seeing residential development. And so it's a big deal for counties like Wabash and Cass when they get that kind of economic development that's coming into their county. So you see people make a little different decisions as a result. But that's a good point, yeah, 1.5% to sell them annually. All right. Well, we're going to switch over, transition to a solar discussion. And I'd like to introduce Chris Shellman. Chris is an attorney at Uline Law, and I can let you give more details on your background if you wish. But like I said, Chris and I worked on the project up in Pulaski County together. I thought he did an excellent job representing a solar developer, but he can certainly talk about both sides of the landowner's perspective as well as solar developer's perspective. And if you have questions about solar leasing, about decommissioning, those are whole things that I think Chris can address. So Chris, I'll turn it over to you.
Thank you, Howard. Good evening. I'm gonna fiddle around here and try to get help switch that up. We'll see. Oh, that seemed to work. Great. Hey, thanks everyone for being here tonight. So what we're going to do is kind of give a little overview of what a solar project entails, and we'll talk a little bit about the lease. But ultimately, if you're in that situation, you can hire counsel, you can dig into all those things, and we can talk about all the legal intricacies, but that's probably boring. So I get that. So what I would like to do is talk a little about the project, provide a little background, and try to answer some questions for what a landowner would want to know, and what the direct impact of a project looks like and what that looks like for them, from the whole process from beginning all the way to construction. So just quickly, I'm an attorney of practice here in Lafayette. My firm has about 32 employees. We have offices in Lafayette, Indianapolis, Evansville, in Minneapolis. We are primarily a business law firm that provides counsel to a lot of ag production, business owners, estate planning, succession planning. We don't do criminal, we don't do divorce. We focus on people investing in life. I have been practicing here in Tippecanoe County in northern Indiana for almost 10 years. And while I don't have any, I'll put it this way, my direct involvement in farming is somewhere in Castle, but that's about it. But I have represented many ag production owners and was former president of the Indiana Bar Association ag section. So let's talk about solar in the Midwest. it's growing, it's happening. You see from this chart, the colors of stuff that's operational in yellow, under development and under construction. There's over hundreds and hundreds of megawatts that are coming online. Now, that doesn't always necessarily mean that there are large projects. What you will see about solar is that there's a variety of ways to do it, and they all boil down to different economics in different locations. But it's happening, and it continues. It'll continue. So the main question is why here, and why now? One thing is a central location that is located around other large regional centers. Here we have Chicago, Indianapolis, Detroit, all the way over Pennsylvania. But what really gets down to this is there's multiple regional transmission organizations. And essentially those are the interstate system of electric power transmission. So these are the really tall power lines that essentially provide backup grid support to all of the utilities. And so you'll notice that Indiana is both purple and blue. And so that's important because you have MISO, the Midwest Interconnection Organization, and PJM. And so what that means is that power that gets put on to either, if you're strategically located on either, or in some cases of the state, both of those lines, you can send power all the way to the East Coast, hit Newark, hit Washington, D.C., and you can go down to New Orleans, you can go up to Saskatchewan, you can go to Detroit and Chicago. And what this does is allow a lot of buyers and a lot of backup use. The other thing that's nice about Indiana from a solar developer's perspective is it's flat. They don't want to push dirt, they don't want to terrace. All that costs money. So Indiana's flat, and so that's exciting to them. The other element is a combination of cheaper panels and rent prices, right? They have to be able to offer you a number that justifies it. And so if you're doing different crops that have higher rents, it doesn't make sense. So it's a balance. And so you need to find a spot where all of those things come together. But ultimately, for large scale projects, the location in Indiana is due to the proximity of regional transmission lines that cover a large portion of the population. In fact, in a couple of projects we'll talk about, and the one that Howard referred to, you'll see the PJM line and the MISO lines are 100 feet apart. So potential uses, what you do with this electricity. One, and certainly probably the most common for large projects, would be long-term demand resource planning. This is a utility that is looking at all of their production capabilities and trying to fill a segment of the power that they will need to serve their customers. Now, we all know that it is only light at the day, and solar panels might have a little bit if it's really big move. But other than that, they only work during the day. So what is it used for? Essentially, what a solar utility looks for and why they would purchase power from a solar project is that the peak production of a solar facility corresponds with the peak demand for consumption. So when it's August, it's 90 degrees and everybody's AC is cranked up, the utility service area is using most of their power. Sometimes they will run a deficit. When they run a deficit, they have to purchase from one of those regional transmission organizations at a market rate, and that'll be very, very expensive. So what they can do is they can purchase a megawatt at a fixed cost in a 15 to 30-year arrangement, because the only variable cost in production is operation and maintenance. There's no fuel risk. So they can say, they can know that at the hottest day, at the most consumption, they they can count on having 1 megawatt or 2 megawatts of power that they can rely on instead of purchasing. Another smaller scale project would be peak shaving. Those, wouldn't be, thousands of megawatts. Those would be much smaller. What you would have of those would be in conjunction with battery storage. And similar to the peak demand pricing, they will store their power until what they assess is the highest part of the day. And then they will pump it onto the grid and sell it at whatever that 26, 30, 46 cents, whatever that is. Two other ones that you don't see quite as much, but one you can have an offset purchaser. One example are sun chips. They essentially purchase the equivalent of the power needed for their industrial facilities, and they get credits that wash out. They don't literally use that power, but they purchase enough of it to offset their consumption. The other would be direct consumption. These would either provide peak shaving for an industrial operation, potentially. I've seen certain bit mining operations for Bitcoin discuss potentially building a solar field to provide their own power. It's a very electric intensive operation. The other that you could potentially see it used for is just backup battery storage on a much smaller scale, something 40, 20 acres or so. So briefly, what I would like to give some leasing considerations, mainly from the developer's perspective, just so the landowner gets some idea of where they're coming from. Rent's going to be very important, but the biggest thing from the developer side, as we talked about, they want to sell their power to a utility who wants to know what it's going to cost them, for the next 30 years. So that being said, they need to know an escalation to the rent that's fixed. So it can range, you can negotiate at all, but they're not going to be able to do a CPI index or anything like that. That defeats, their economic purpose of their structure that makes it viable for the large assets. So I think that's something to keep in mind. Also, is term. They need this long term. They're going to need 30 years. That's going to be the intended life cycle, the first phase. It could go longer. You'll probably see an option for another 30 years thereafter. But what that will allow is the replacement and a reassessment after 30 years to see if the electricity prices, are still consistent with the new modern panel technology and would allow that. I don't see much going really beyond the 60 years. So I would push back if I were you on that. You can always enter into another agreement. Financial interest. The other important thing from a landowner is restoration. There's a couple details. You want to make sure that any compaction or any lay down yard or anything created on your property that's restored, that your topsoil is preserved, and that ultimately I would want a bond to secure the performance. The other key detail that you'll see some people get caught up in is you don't ever want the project on your land when they're not paying you money. Some will ask for a year or two after the end of the lease to decommission. I wouldn't want that, and we should be able to negotiate that. The other thing to keep an eye out would be right of first offers and right of first refusals. You'll see some developers put those in. I would limit it to areas that when you're talking with the developer that will be used for either operations or potentially a substation, large infrastructure. You certainly wouldn't want that included in a larger scale lease. One of the benefits that you could have of going into this long-term lease with presumably this higher rent is the opportunity to sell it 1031 money and go buy more production farm ground. So we'll participate in that cycle that Howard was talking about, where people have more cash. But that's one of the potential options here. So what I've also tried to include in these, and I'll kind of point out, I tried to take and provide some real actual images of what a solar farm, and particularly the construction phase, and ultimately what it will look like. They're not all super glossy brochures, but these are real actual images taken from a project that I worked on up in Stark County that is currently in the construction phase. It's about 400 megawatts, about 5,000 acres under lease. Not all of it's under panels, but as soon as it's under lease, we can talk about what that includes. But if you look at this picture, you can see that this is a mobilized construction site where there's a little small, but the little black dots out there are driven piles that will ultimately hold the panels. The roads are access and service roads, and you see a little bit of staging in front. So after the lease, there's a couple main practical realities. So first, you'll see some initial design and testing. Then you're going to go get your land use approvals, whatever that may be, talk about that. Then once the developer knows they can do it, they're really going to lock in on the legal and practical side. So they're going to get their project ready to take it to market, to get the cash to build it and finance it. And they'll go through the actual financing. They'll negotiate with their lenders, which is probably going to be a combination of parties. And we'll talk about how that will impact the landowner and what that'll look like for them. And then finally, we have construction. So the initial design and testing, what's going to happen, so you met, whether it's the developer, realtor, an agent met with you, you negotiated your lease, it's signed, what happens next? For the most part, very little from the landowner's perspective immediately. You're going to see some initial surveys, potentially, so a surveyor will be out there. You're going to potentially see some soil samples. You may see some initial environmental studies and stuff like that. Wetland delineations. For example, this image is of that same field that you saw under construction, but it is a topography survey that was performed. Ultimately, they'll be minimally invasive, and in almost any circumstance, if you or your lawyer did your job on release, if there is any damage, you're going to be paid for it. So as we talked about before, it's flat. There's really not much contour on this farm in Stark County. So what will you be asked to do? You're going to provide access, to your field. You may need to notify your tenant if you have it. They may ask for tile maps. They may ask for any existing surveys that you have. That's pretty much it. They want to know if you have any ground in CRP, because what they're trying to do is prepare a site plan like this, so they can come up with what type of land they're actually going to be able to put in production and how they're going to connect it. Next, once they figure out where they can do it, what it looks like, and that they've got a viable project that they piece together, with all these leases, you then get to meet your neighbors. So you're going to go, and depending on the county, there's a lot of different regulations. You could potentially have any number of hearings and any number of requests. What you will see as the landowner is developer is going to submit their application. They'll have a bunch of plans. They'll do, provide information on what it's going to look like, how they're going to operate it, and so forth. And they will go and look if they need to rezone the land, get a special exception, do any other type of land use approvals that may exist in that particular county, or they'll go through the process of submitting for the building permit if it happens to be by right. What you'll probably see is, even if it's by right, it's not going to be that quick. Most of the counties are, even if they're very supportive and open to it, they're going to take their time. They're going to want to understand it, and there'll be a lot of both private and public dialogue and discourse with the local officials. Now, what would you be asked to do as a participant You'll likely need to sign some sort of consent, authorizing it. In almost any circumstance, we're going to protect your specific lease term. So you don't really need to worry about your neighbors down the road knowing you're getting paid in rent. I'm not saying they will all try to find out and, run it all through the mud, but that's not going to get disclosed by, us or the developer or council. You may be asked to attend hearings. Different people will have different levels of comfort, but I can tell you that local landowner participation is crucial. This isn't just the developer doing the project. These are the landowners along with the developer doing the project. And that's what really makes a strong proposal to the county and ultimately allows it to be I think can be, if it's designed properly, can be an ultimate win for the county and community. If you're not into public speaking, a lot of times, private conversations, depending on the specific type of land use approval that's needed, communications with the voting board are appropriate. And a lot of times in-person conversations, with those people can be very impactful and helpful. Now, I guess one more thing on land use, I'm going to be one. Some people don't like it, so that can take the form of all kinds of things. And even once you get your approvals, depending on the level of remonstrance, their financial support, and how much they want to fight, you could get your approvals, and it could take everywhere from months to years to fully resolve and finalize those permits and approvals that you may have wanted to hear. Once you get that land use, then you're going to go to the pre-financing. And so from a developer's perspective, they know, some of what their lender is going to want. What this project is potentially a 30 to 60 year development on a land lease on your farm. So they need to go take that project. They're going to own the pilings. They're going to own the panels, and they're going to have the legal right to the leasehold on your farm. And they're going to take all of those things, the theoretical leasehold ownership, the physical improvements that are going to be constructed, along with whatever agreement they have to sell their power, and take it to a lender and finance it, just like you would with your ground or anything else. So they need to make sure that everything is in order, and just like when you submit for your loan, you need to have all your ducks in a row. And so what does that look like? So at that point, they're going to do title searches. They're going to review that, particularly if ground has been in the family a long time. Sometimes there's gaps. Sometimes grandma and grandpa aren't here anymore, but it's still in their name, and the auditor still took the check for the rent or for the taxes, and nothing ever got fixed. So now's the time where you might get asked to start to clean those things up. And what I think you'll find is the developer and the council, I spent countless hours reviewing the title and getting this stuff done. They'll help you do this. If you already have counsel, they'll work with that counsel to make sure that we need to update who actually owns it. Potentially, you could find easements or other stuff that isn't used that may impact it. You can reach out about releasing those types of restrictions if they exist, or more likely amending the lease to account for what land will or won't be used in the project. Sometimes you'll see, this time what you'll really see is they did a survey originally. It was probably just a boundary survey or kind of some initial review. What you'll see at this point is a full-scale ALTA survey. So you'll see teams of surveyors out in the fields, and these will be very precise. They will show everything that's out there, ditches, electrical easements, everything that's on your farm will be surveyed and shown on this. It will likely provide access to the information if you want it, but what you may find and what you'll often see, particularly in rural farm settings, is the northeast quarter of the northeast quarter looks a little different when you actually go out and take an alt survey. So if there's any discrepancies, if there's any boundary disputes that don't match, unfortunately in these large scale projects, inches don't matter. It's not like you're building a skyscraper in Chicago. So what you'll often see, the actual direct impact of that is negligible, but they will need to clean it up and release. And so if it turns out that, there's a fence line that, doesn't include 20 acres that they technically own on the deed, they're going to want to shorten up their lease because the lender may have a problem ultimately with what they would think is an adverse claim to the leasehold that's developed. The other thing that'll happen that's pre-financing that isn't exactly a land use approval is a lot of these projects will go for a tax abatement. And that's a big, scary process in theory, but it's really not. That'll be another public hearing. There'll be publications. And I guess I'd like to take a couple minutes to talk about what that abatement is and what it looks like and what it does. One, the majority of the abatement will be on the real property values, taxes, and the personal property. Right? Panels, pilings, all of that is the personal property, and they'll seek a tax abatement from that. Oftentimes it's 10 years, 15 or 20, and there'll be some flexibility in that based on the mechanics. So there's a lot of misconceptions with what the tax abatement is. A tax abatement does not reduce any of the revenue that goes to the county. Often, in most circumstances, a tax abatement will allow for an increase in revenue to the county because it won't be funneled in to the general tax base. In Indiana, if the tax base goes up and the assessed value goes up, property tax bills are going to go down and the county won't get any more money. So what we'll see is the county wants to take advantage of this potential revenue stream, and so they'll be supportive of tax abatement so they can fund other projects. The next phase, once you get your pre-financing, will be actually financing. And at this point, the developer is going to finalize their plans. They're going to talk to the lender, lender's counsel, and this is going to be probably a miserable experience for most people. It's just dozens and dozens and dozens of lawyers. What they'll be doing is they'll be reviewing the environmental studies, they'll be reviewing the surveys, they'll be reviewing the title documents, the construction plans, the estimate that the developer has, and ultimately the land use approvals to make sure that from a lender's perspective, they're mitigating as many risks that are out there. There's not much direct impact on the landowner on this side, but what you will likely be asked at this point is if you haven't recorded memorandums of the lease, they're going to want those recorded. They're also going to want you to sign lease estoppels. Essentially, what that's going to be is an additional document between the developer and the landlord that states there's no defaults, there's no discrepancies in the rent, there's no discrepancy in the acres. So everybody agrees right now, once and for all, what land's included, what they're going to get paid, and how it's all going to happen. So lender wants that additional comfort. We'll also want to clean up any lease issues that exist. And then finally, if your farm has debt on it, that's not a problem. But they'll likely ask you to sign a subordination, non-disturbance, and a torment agreement with your lender. So farm credit's out there, you've got your debt. Our lender is going to want to go to farm credit and say, hey, if our developer defaults, you're not gonna bother us and you're not gonna kick us off as long as we pay the rent. Most times they're okay with that, but that would be the main thing that we have to do. This image is a solar farm that also has sheep grazing on it. What you'll see in some areas, and certainly the larger ones that people do it, is mix in some other agricultural activities. Depending on your layout, and certainly the ones in Indiana that I've dealt with have been pretty spread out, 15 to 20 to 25 feet between rows of panels. Theoretically, I mean, you could have hand harvested crops like berries if you wanted to do that. You can also do sheep in certain areas and allow them to deal with some of the ground cover. Then we get to construction. What will likely happen is at some point between their construction or their financing and when they want to commence construction, they're going to provide notice to you as the landowner. Depending on the season and when that is, they'll probably reach out and get access to the site, potentially plant ground covers. They don't want a bunch of mud there to the extent that they can prevent that. And in fact, they're required to prevent soil erosion from going outside. What the developer will then be doing is finalizing any agreements with the county, whether that be a road use agreement, decommissioning plan, and any other type of assets. They'll also finalize their bond and then go to construction, mobilize the stage. What I think is important to note is you can see we talk about the spacing, and we'll have a couple other better pictures of it, is that the panels themselves, they run north-south so that they can track the sun east-west. They rest on pilings that are driven into the ground. There's no concrete. Next, you can see they take a steel piling and they drive it in the ground. And they put a cross beam across it. Then they attach the panels to that cross beam and they track east to west. When the sun comes into the panels, it converts the sun into direct current. The direct current lines run north-south to the service roads and then go to an AC inverter. The AC inverter converts the direct current to the alternating current. And it isn't until that point that any lines go underground. At that point, they will put the alternating current lines, which would be a higher voltage, underground. And for practical purposes, they'll run them along the access and service roads to the substation and then ultimately to the point of interconnection. But there's not much concrete. I mean, not like a wind turbine where they're dumping tons and tons of concrete and they're holding up. There will be a small pad for the AC inverter, and there will be a concrete pad for the substation and the transformer for the substation, and the point of interconnection will be gravel and concrete, but that's it. The pilings themselves, which take up the vast majority of the project, are driven directly into the dirt. Around your farm, you'll see the construction and installation of fences. Outside of that, you'll see the sediment fence to help with erosion and prevent that. And you'll just see a bunch of pilings getting driven into the ground. As we talked about, this is the project up in Stark County to give you some idea of how the patchwork comes together. There's about, I believe, close to 6,000 acres leased, but as you can see, there's a bunch of things that go into what you actually get down into creating your 400 megawatts of electricity. You'll see there's wetlands, there's low points, there's wildlife areas that you want to protect. You also don't want to cut down trees. It costs money and you don't need to. That's the benefit of some of these locations. So you'll have this patchwork that boils down to where you actually install panels. Finally, I have a short video that will provide some drone imagery of this particular site under construction. There we go. Can do this. I'd be happy to answer any questions. Yes.
So, you know, I want to age myself out, but we're all gonna be dead if we do this, and by the time the lease runs out. And we're gonna know where things will be 40 years from now, because that sounds like that's gonna be an average lease in terms of, you know, what our family, even trust, and what kind of things happen to that. And better yet, how do you sell it? You know, I don't want this property anymore. Now it's got a solar field on it. How do I get rid of it? People buy it, they have to take over that lease, they know they can't do anything with the land.
That's what they want. They want the cash flow. They want the rent payments. It's going to be a little different than the farmer operator purchase of ground, but it's going to probably be someone more like the investor who is purchasing a cash flow. It's like any other real estate deal. Most of what they're buying, you know, it's all done different ways, whether it's a retail center, multifamily housing, whatever it is. Ultimately, what they're purchasing is the cash flow with the benefit of appreciation.
Okay, so what does that do to the value of farmland? Farmland in the last 20 years, just had a lecture on it, what it's done, and, you know, it's gone up a lot. I mean, a lot of stuff selling for 19,000 an acre now. What happens once you put a solar field on it? Does your value of your land go up like farmland around your town?
That's yet to be seen, but ultimately, if people are buying an income stream, Howard talked about cap rates being at 2% for farm ground. That assumes, you know, an infinite use of farm ground. These rent payments aren't infinite, so it probably won't be 2%. I won't step out of turn, but I'm not the appraiser, but it's probably not 12%. So if you look at your rents, which you'll see, you know, rents for a solar farm going anywhere from 600 to 1,300, depending, you know, an acre. Somebody's going to pay something for that income stream, and we'll see how that plays out. But it's designed to be sold. And what you'll probably do is, you know, open up to buyers that either are institutional or wouldn't have necessarily considered farm ground. Yes.
Does the solar company do the mowing around their, or is that the landowner? Around their farm there?
That's going to be the solar company. They'll subcontract out. But what I will note, and I'll go back. Maybe I'm broken. But I was going to go back. Let's see if I can make it come up again.
Chris, I think it's safe to say that all additional costs, all additional real estate taxes, everything associated with the development is borne by the solar company.
100%.
The landowner will continue to pay basic insurance and the real estate taxes they historically paid.
The base, correct, the base real estate taxes. So if the county assesses it at a, you know, if you're getting assessed at $2,000 an acre for the farm ground, and it goes up to $10,000 an acre, the solar developer is going to pay for that $8,000 an acre increase. But for the actual operational maintenance, all of that's borne by the solar developer. But what I will say is that a lot of these projects have relatively large setbacks. What I was going to show you is that one of the images where they started construction, you can see several then they were growing corn right up against that fence, between the fence and the road and the neighboring property that wasn't participating. So some of the landowners are still farming some of the ground that's outside of the fence that was used. We talked about what the actual panel coverage, and that's not, most times not the entirety of the farm. And so if it works out that it's not the full farm, we're seeing landowners actually go and continue to farm.
So the property they were talking to me about, I own in Fountain County, and it is definitely not like your pictures. This is all rolling hills. They're gonna come in there with bulldozers. They've already said that. So do we have to put something in the lease saying, listen, when this is over, you need to put it back to the way it was? And how do we assure that they're actually gonna do that? They're still in business and we can enforce that. How does that happen?
So.
The topsoil's gone, it's gone.
I wouldn't let it move the topsoil.
Right. So as the landowner, we don't get to go on your farm unless we agree how we're gonna do it, right? That's your property rights. I just can't go on there and do it. So we're gonna negotiate that in the lease. If I were you, I would say, you're not gonna terrace my farm, right? And you're not gonna disturb my topsoil. And if you are gonna let me do that, you're gonna make sure I bring it back when I'm done. Now, what we did talk about is a bond. And so there'll be a performance bond that I would want negotiated if I were you with the landowner, that in the event the project goes under at any point in time, there'll be an insurance payment to cover the cost of decommissioning, which will include any restoration that you have negotiated in the lease.
But how do we ensure, they pay for their insurance and that that bond's still in force? I've been through this stuff, there's the car clubs and stuff. We thought we had insurance, went to a meet, and it had been changed someplace along the line. It was no longer in effect. And we ended up.
It's paid up front.
collapsed because of that.
It's paid up front.
And that's for 50 years. That bond's in coverage for 40 or 50 years, and you know, the length of the lease.
Correct. Yes.
Well, some of the rent payments to the homeowner or landowners, what we've been told, it's high enough that why don't they just the developers buy the land themselves? I mean, over a course of 30 years, they could have paid for that land. And like 30-year payment, it's almost cheaper just to buy the land.
I mean, potentially, but it still requires a lot more capital and a lot more capital on day one. And first and foremost, they got to build their solar farm. Like that 400 megawatt project, it closed construction financing with $560 million, with an additional $100 million of tax equity, and then another $80 million of cash invested by a foreign investor. So it's a lot of cash, and then to then go buy 6,000 acres of ground at
$10,000, $15,000.
I mean, it doubles your project. And, just like we talked about the landowner potentially participating in this project, getting it live, getting rent payments started, and then potentially selling it, you very likely will see some of the investors and owners in these projects, once they get developed, selling it to another pension fund or something like that that's looking for a long-term income stream. And so then they'll turn that, make that delta on that rate of return, and then go do the next project.
And Chris, isn't those sort of a tax strategy for them that they can deduct all of the rent, but if they buy the land, it's not deductible?
Correct, only interest, so that they can deduct the rent. And in addition, I mentioned tax equity investment. And so the developer oftentimes has less income, right, than say the investors in the project. And so what we'll do is we'll structure, creative entities and partnerships that allow the investors to take full advantage of all of the tax incentives and the bonus depreciation and all of that of the project. All of these are improvements. Like you go build a bin and then you bonus depreciate that. You're going to see that happen with this project. And so that's going to increase the rate of return to these investors. Yes.
Yeah, I was just curious. I've been around some solar development while now. And one thing that people always are curious about is what percent of the income coming into the solar farm is from the carbon credits. Would you know?
It's gonna change from time to time. I don't know offhand, but the main driver of the income for the project, is going to be the long-term sale of the electricity. They're very long-term agreements. Most of the credits and what you'll see in the structure is what I've seen is the credits that are, for the installation. And those will be 25% on average. And so it's a big number, right? If it's $1 billion, that's $250 million of tax credits that's gonna roll through. And on that particular project, Bank of America did the tax equity financing, and so they took that to their investors and spread it out and utilized it. But that's what helps the developer, bring less cash to the table.
If you've got an 80-acre farm and they put panels on 60, are they leasing 60 acres or 80 acres out of it?
It just depends. Potentially, if they want to have the right to use it later, they'll lease the whole 80. I've found other circumstances where they'll find out that it's not included, or if they can't use it for whatever reason, and they'll will have the right to pull it out of their lease. Practically, I can only speak for the ones that I've worked with. Most times in that circumstance, they'll sit and talk. If they have another use for it, potentially they can provide, connection to other sites across that. So if the 20 that they can't use, maybe they could run underground lines and connect to the farm. Most times they'll just lease the whole thing.
So because these solar projects are so new that they haven't really been time tested yet at their success rate, what is the expected success rate of these projects that, hey, they're going to be able to pay off their leases 40 years into the future? Subaru is here today, but in 20 years that factory might move and they might look for new buyers to sell the energy to. But by then, 20 years in the future, we could have liquid salt energy plants, fusion, more investment in nuclear, and that production of solar is so much higher than these future energy developments, because these contracts are just so long. What are we expecting that, hey, 9 out of 10 of them are going to be successful in paying their leases 20, 40 years in the future, or are half of them going to fail? Is the market going to get saturated, flooded, and the cost of energy is going to drop so low that they won't be able to pay their expected lease?
So this is my opinion. I'm not speaking on behalf of anyone else here. What I would note about a solar farm, and you're talking about the risk, in my opinion, the risk is all on development. All of the cost of a solar farm, for the most part, it's going to go under during construction. Once it's up and operational, it's got so much value in there that even if someone comes in and buys it in bankruptcy at a discount, it's running, right? So all they have is the operation and maintenance, and they have a contract that they've sold the power to a utility that is essentially, if not actually, monopoly, that can take the money from the ratepayers and has agreed to pay it for a 15, 20-year. That income stream that they have to pay the rent is going to be there if it gets built and if it gets operational. So I don't think it's a 20-year risk, but I think it could be realistically a 2 to 6 year risk. But that's where you're going to rely on the bonding and the actual wherewithal of the developer and their experience. Now, I don't know about the long-term risk of electricity on year 30 being so low. I hope so, yes, but I just don't. I don't know. Yes.
Chris, we got an online question. When we look at the income per acre, what are you seeing as a good agreement?
For rent?
Yeah.
1,000 plus. But it also tracks with productivity, all the same things that go with your cash rent. It's going to track. It's just going to be closer to total income per acre rather than cash rent income per acre. Yes.
We went through this about a dozen years ago with a proposed wind farm. And they gave us, we signed up and they had a few dinners and we went up 2 or 3 years. And then the whole thing failed before they constructed anything because they did not have a signed contract with Duke Energy. And Duke Energy basically blew them off. And so because they did not have that customer to buy their electricity, the whole project failed. These developers here, do they have that little loophole sewed up?
These particular, yes, they had an agreement with AEP
Okay,
to sell their electricity. Yeah, they would never have gotten the $500 million to build it without that tied up.
What type of inflation investment are you seeing on those? Over the course of years, 4%.
Not that, much lower, much like what we've seen in the last couple of years, 1.5% to 3.5%. But I mean, it's also, in fairness, that's what's been happening. So I'll be interested to see what the recent inflationary rates will do to that. Yes.
Got another online question. What happens if the developer goes under, bankrupt, or simply is dishonest and doesn't pay the rent?
Well, at any point, they default and there's a bond in place. That bond would that cash would be released to secure the decommissioning of the project, which, should decommission it consistent with the lease and any other county requirements, which would include removing the panels, removing the pilings, removing the lines. Most of the time, it's lines that aren't buried under 5 feet, so anything less than 5 feet, they'll pull up, and replace. Most of the bonds, in the decommissioning agreements that I've seen, provide an initial 5-year window, and it needs to go back and be revisited to make sure that, they weren't projecting 7.5% inflation. So when you get to year 4, we need to update it, we'll account for whatever that may be. But ultimately, it's going to be the bond or whoever else comes in and buys the project that goes through bankruptcy. Yes, in the back.
What's the thought on impact from facility when land sits fallow for large load from the term? And second question, how would you protect, privacy from neighbors talking about their concerns?
Sure. The first, I'm not an agronomist, but I've had many tell me that it's ultimately a big win for your farm ground. It's going to be fallow for 30 years. It's essentially CRP, but you're getting paid a lot more. So that could be a positive. What gets put down, I can tell about that project, they use ground cover that's meant to keep the topsoil there. So it'll have a chance to rest and restore. The next question on, secrecy, the lease, it's their word. I mean, the leases have confidentiality provisions, but, the coffee shop, it happens. And then you get potentially a vocal opposition, which is out trying to, maybe I'm playing my hand, but they're little conspiracy theory strings that they're piecing together about, who's pulling all of it. It does allow the river mill to run, but, I guess it's the same problem you have now. Yes.
So, the kind of letter of intent that we have, they basically say they're not going to pay you anything until they're up and running. So that could be what, 2 years, 5 years, and you're not getting anything, and your ground's just kind of not useful at that point. What?
You can farm it.
You can still do something, even though.
Yeah, so you sign
a
up.
lease.
Yeah, so you're signing your lease on, let's say, this project. A lot of these people signed leases in 2019. 2019 and 2020. Went through, started a couple of rezones, in Stark County in 2020. Went through, title in 2021 and got everything all squared away. And it closed its round of financing this June, which then allowed it to go to construction. They technically mobilized on their own dime prior to the full construction financing. But in March with just preliminary mobilization, and they started construction in earnest right after at the end of June. So all up until 2022, the landowners farmed the ground, and in November, the notice went out saying that we're going to plan on don't plant. Our goal was March. We missed it. A lot of times you'll see the developer will then initiate their construction phase, which does start a payment. It's generally not the same as your full operational rent, but there is a construction payment. And we'll tell you about the plan, and then we'll go out and plan our ground cover. One more.
So what would the landowner's responsibility be? You talking to FSA, or what does the landowner need to do? And what is the ongoing costs for the landowner? I'm supposing a lawyer, and how long does that whole process go? The lawyer, does it continue on with the lawyer, paying $600 an hour for the lawyer? How long does that last?
So as you have a landowner hire a lawyer to go negotiate your lease?
I guess, I mean, you have to, I presume you have to get a lawyer to work all of this out.
Yeah, I mean, certainly some do it, and that'll be a lease negotiation. It depends on what the initial lease looks like, how long that's going to take. And I've represented some clients, in the leases. Most of the time, you're talking, a couple weeks, and you can get it hammered out. It's not going to be a long-term process. What I talked about and what the lawyer was doing from the developer side, I can tell you that I worked on this project almost every day for years. And so most of those things, you're not going to need a lawyer to do. If you do want, so let's say we talked about the SNDA or an amendment to the lease, the lawyer for the developer would provide a copy to you and your counsel if you had it. They would review that however long it takes them to review it. And typically, we're preparing the documents, so a couple hours, and then if they have changes, that gets negotiated and so forth. I'll say from my experience, the most protracted, discussions with the landowners were not really about the leases. It was more about ancillary purchases. If we were trying to buy a house and a barn for our operation facilities, or if we wanted to get the site for our point of interconnection, those were the things that were much bigger, negotiations. And there wasn't much interaction with landowner counsel. So I wouldn't think, all that much, whatever they charge, and consistent with any other agreement that you have to work on.
Yeah, don't want to be caught going, oh, you should have been taking care of that. You should have talked to the FSA. You should talk about the.
Now the developer is gonna run all of that.
Thank you, Chris.
Yeah, to your question, I had a client sell 3,800 acres to a solar developer, and we had minimal time and minimal attorney expense in that compared to what he actually earned from it. And the developer did it all. They did all the work, all the looking, permitting, et cetera. So with that, we're going to turn it over to a farm bill discussion from Farm Credit, and Chad Lanham is going to lead that discussion. So while he gets this set up, again, there's drinks in the back and food outside if anybody wants to grab something. And we'll Turn it over to Chad.
There you go.
Thank you, Howard. All right. Well, thank you. Good evening. My name is Chad Lamb, Senior Financial Officer, based out of Lafayette here. A few of the team members that work with us, I think, have kind of scattered, get a drink here, but Kenzie Kretzmeyer in Lafayette, Kristen Farr coming in from the Cookville market. Connor Bonnell works in Williamsport. Kyle Harvey is here in Broome County. I think Matt Ellingsworth over here from our Newton and Jasper County offices. So I want to go over my career. My boss, first boss says all good meetings start on time, which we did, and we'll end on time. So we've got about 15, 20 minutes here to go through two topics: inflation and agriculture and how that relates to you, and then the farm bill. If you're here to think you're going to listen to a graduate level master's course on macroeconomics, this is not the room for you. I wanted to go over a few slides that would dictate some of the trends we've seen since the pandemic. What is it we've seen in the last couple of years into 2022, and then more. Really, what I want to convey is, as a lender's perspective, what do we see and what do we advise our growers, our customers on, when we get to those year-end conversations. First off, here real quick, farm credit, we're cooperative. We're owned by our members. So about 135 member owners, 285 advocates. We cover 4 states. We have 82 offices out of those 4 states, headquartered in Louisville. Financial performance, didn't have 22-year information yet, but if you can see there on the left, we're closer to 36 billion owned and managed assets year-end 22. Happiness program, if you're customers, you understand that, but here the trend line is going up sharply, similar to interest rate market, but you can see there at the bottom, 858 million a year in 22, and if that goes out, will be over $1 billion paid back to our customers. So getting into the presentation itself, inflation. We heard a lot of talk, are we transitory or are we long-term inflation? How will that have an impact on our operation? And if so, how long we're going to be in those discussions? I think clearly we know that the transitory is not the case. Interest rates rise, obviously they have. How high do they need to go to combat inflation? You don't have a guess? I think that's fair. We'll get back here in a few minutes. If anyone tells you exactly where it is, I tell them to go buy a lottery ticket. I don't know if anyone in here has a crystal ball to exactly what the Fed will do to combat inflation, but there are some things that we can glean information to. Here we go, really don't know. What is inflation? Simple definition, too many dollars chasing too few goods. Simple supply and demand equation, right? Another easy way to measure, we track CPI is a common measure. So if you look at here at the start of 22, the increase in the summer, months of 22 to 9.1, and then year end, we're back down to 6.5. So I'm going to say, hey, there's some fresh relief coming from the inflation side of things, and I could agree with that. Is it real or nominal? I think Howard did a great job talking about real and nominal inflation when it comes to the real estate market. This is where I want to spend a little bit of time on. When inflation hits, what are a couple tools that the Feds have at their disposal to combat that? Quantitative easing here on the left. That's what we saw out of the 22 pandemic. What is quantitative easing? Any guesses? Go ahead.
Propping up the stock market.
One way to look at it, it's a mass infusion of cash into the liquidity system, right? A lot of funds went into it. The government's buying a lot of securities. And what happened as a result? Big drop in interest rates. Okay, so coming out of 2022, we'll see a chart here in a minute. We go into inflation response. When things are getting a little tighter there, another tool they have is quantitative tightening. And that's just simply the opposite. We're reducing the balance sheet, the global economy, and more over here in America, selling securities. And what happens then? Excessive interest rate rise in the market.
Here's a 10-year yield curve. I don't know if many of you look at that, but it is a pretty good cursor as to where we're going. You look at here, 2022 is the pandemic getting full circle. What was the big issue going into 2022? Labor shortages. We talked about logistic issues globally. We saw those a lot here in America. So what, that quantitative easing was put into place. And here, a big drop in interest rates there in 2020. Carry it forward to where the inflation kind of took off, and you can see where interest market on the 10-year yield bumped up to over 4% at the highest. And there has been some up and down, obviously, as we go through. And people have short-term memory. They think, hey, this is really high, historical highs, historical lows. Well, we were at historical lows, no doubt. Snapshot forward, and Craig, you were lending money in the 80s. What were some of the interest rates in the 80s?
You got high, latter 70s, early 80s.
Well, whatever. It's wrong, but. I told you to get you out here on time. Yeah, I mean, they're high, upwards 18, 20%. So that short-term memory comes into play when we look back at that historical chart. Back here, and when I started farm credit, it was somewhere in 2010. We're still lower than where we were then. A big margin. Here's I think a telling graph, and this is just the money supply chart. So all the liquidity of money in the system in the economy. Look here at 2020. You draw that line, if I had a line on here, charted trillions of dollars. When the government enacted the easing program, quantitative easing, it dumped almost $7 trillion in the economy. To give some reference to that, here's the farm sector balance sheet. So you can track it from 2000, every 5-year increment, top line. All farm assets, so we're looking at bushels, bales, livestock. $3.8 trillion. Year in 22, total asset. We just talked about $7 trillion, and more than double the farm sector balance sheet is just cash liquidity infused into the market. It's a big deal. This chart, I think, is interesting in the fact that if we look at the historical inflation rate versus the Fed fund rate. So the Fed funds is, counterbalance as to what's going on in the inflation market. Inflation goes up, Feds move the rates. We just heard that we think another 50 basis points coming. We'll look at a slide here in just a second. But what I think is interesting here, if you look at 2022, and Howard mentioned it earlier, what was the year that you said was most likely the most similar to 2020 in gross income?
73.
73. So we look a little closer to 75. The 75 looked very similar to 2022. Inflation rate pretty similar. Fed fund rate very similar. I'm not going to predict or say exactly what's coming next, but what happened in the 80s? Time will tell. 2023, 2024, people think that, hey, we're going towards a recession. You already be one. Not going to go there today to say that that's where we're going. Farm sector debt, income. I think Howard again did a great job. One thing I highlight here in Howard is in 2020, look at government payments. In billions of dollars, 46 billion, just getting back to more traditional norms of here in 2022, 17 billion. I think going forward, those numbers are just going down even later. Here's what I was telling you earlier, and Chad, you hit it on the head, 50 basis points. So if you want to, you can go to this website, CME Fed Watch tool, and we look at it. It'll give you a countdown. I put this in there yesterday, so we're 8 days away from the next Fed meeting. You can look, here's February 1. There's a 99% probability that we're moving to 50 basis points per this chart. You can go in there and look at the March meeting, the May meeting, and then we'll have different probabilities of where we think we're moving. It's a good tool to watch to give you kind of a precursor of what things coming. Farm debt, Howard had a slide very similar. The only difference with this one, color coded. So green light, we're good. Red light back here in the 80s, not so good. 2022, where are we at? 3%. So we're in good shape. I think there's a lot of dynamics that are pushing their record income, obviously. This chart, we'll spend a lot of time on it, but it's no surprise to any of you here in the room in the livestock or grain markets. 2021 on the top line, the lighter blue, 2022 is the second line. Everything's up across the board except C. You think that's coming down in 2023, Larry? You heard that's coming down?
No.
No?
Don't be a pessimist.
Already got her blood, I already know.
You already know. And so here's really what I want to go into. The slides do tell a little bit of a story, but, you know, the initial impact of inflation usually feels good to the ag sector. Why is that? Land values go up. What else goes up? Commodity prices go up. What else?
Tractor prices.
Tractor prices. So really, everyone in this room kind of hits that, okay? Most of the ag assets on our balance sheets have appreciated, they're going up. However, the longer this goes on, the more difficult it becomes to manage because capital assets, they tend to erode over time, right? Replacements happen. What happens to those assets you have to replace now that you have on your balance sheet?
A lot more to replace them.
Costs a lot more, equipment values up, interest rates are up, so those assets, as you roll, you're paying more for it. Margins, and margins have been great. 2022, we talked about how it was a record year for income. However, at some point in a commodity-based market, there's ebb and flow. They will come down, and at some period, there will be a loss. So, point blank, there are a lot of dollars at risk in this market. Your balance, you know, your inputs for 2023, Larry just mentioned, there's no savings, right? Things are high. There's more dollars at risk in terms of the bushel, your pounds are produced, and the acre that you're buying. A lot of dollars at risk on the table. So some suggestions real quickly. Stay agile. I think that's true in every market, but especially in a market where there's a lot of unknowns, a lot of draws and drains from every angle. Keep your liquidity strong. Working capital should be great. You know, the balance sheets that we've seen come through, working capital position is good. The goal would be keep it there. Monitor cash flows. I don't know how many people put together cash flow. Are there very many people in here that historically do cash flows? I think if you do, you can trend year over year or month to month progress that you made and expect margins at some point to flatten out. So if you know your cash flow, you know your break evens, you know exactly where you need to be, you can manage things a whole lot tighter. Marketing plan, I don't know if I didn't see Dave about that, I saw him on the attendee list earlier. You know, have some marketing plan in place where your floor is set, protected, but leave your upside open. Manage your interest rate. We've talked a lot on interest rates today. Howard mentioned that, you know, fixed rates were across the board, probably a big difference in why we're not in the same boat as we were 70s and 80s. However, the variable rate today can save, but it's always a judgment on where the best fits in your operation. Production ag is not a short game. It's not a sprint. It's a marathon. It's a long game. It's very capital intensive. You're making these large decisions where you're putting solar on your farm, where you're buying equipment at extremely high values or real estate at high values. Stick with your plan. You don't move and move all over the board on whims that come in the market. Quickly, farm bill. We talked about it. Howard, you mentioned that you talked with folks that say, hey, there's really not going to happen. A lot happen on the farm bill, and I wouldn't disagree with that. But I still think there's things to talk about as we go into the season, knowing that the 2018 farm bill expires here this September. What I have at the top here is elections matter. Have you ever heard that before? Elections matter? They do. You know, it's no different here in the farm bill discussion. I share this chart. It has absolutely nothing to do with the farm bill. However, I think it gives some credence into how things were developed in here coming to the midterm elections. So as a vote, public sentiment. Who do you want to be in charge of Congress? Republicans or Democrats? And this is starting back in August of 21. There's two circles highlighted. The Democrat were favored to kind of lead things until here, fall of 21. And the discussion was inflation. Who the American public felt better to handle Congress. Changed to Republicans. The last circle, again, totally nothing to do with the farm bill, but it was a change as a driver going into the midterm elections. Roe v. Wade Supreme Court decision that changed that dynamics just a little bit. End of the day, what I want to share, very slim margins, and you're all aware of that as we go into the 118th Congress, the Senate, +1. We got the VP Democrat to break vote, and then the House. 222 to 213. So Republicans are in charge of the House. Very slim margins though. Going back to the last time when the Republicans had control, a lot more red on this chart than what we have there today. Here's the Senate and House leadership. Why does it matter? Well, I don't think it matters a whole lot other. Now they know that after 15 votes, Kevin McCarthy is now the House Speaker. You watched that, it was a long week and a half and very painful to watch. You got G.T. Thompson, he will chair the House Ag Committee, and then Debbie Stevendow from Michigan will chair for the Senate. Here are the Senate Ag Committee. So the seat are there, and we've got local representation, Mike Braun sitting on the Ag Committee here. Some other names you may see: Booker, Gillibrand, Klobuchar on the Ag Committee. I don't know they're all their policies, but I don't know that some of those will have the same wants and wishes that maybe we think of we need back here in terms of crop insurance being a very vital part of the Farm Bill and their views on maybe what's more important for them. I think this slide shares a lot in terms of operation risk, rough road ahead. There's going to be some rocks, there's going to be some mud, there's going to be some waters to navigate, and there's surely going to be uphill battles to get this Farm Bill, if it even gets finished this year. I'm with it. What I really want to hear here in the Farm Bill discussion is the cost of it. Any idea of what the cost of the Farm Bill? You can look there if you're Dick, if you can see that bottom line. Estimated by CBO, $1.3 trillion in total almost for the Farm Bill. Biggest part of that, the SNAP, the nutrition piece. A little bit gray, fuzzy to read, but over $1 trillion. I think another thing to keep in mind is climate policy, conservation. Conservation is great. And I think you'll see the two sides, Senate and House, waver back and forth on what priorities they think are the most important. So we try to interject a lot of climate policy into the conversion title, conservation title. How that will be handled, yet to be seen. There's probably two sides of the story we'll get to in a minute. Conservatives, we talked about the House is controlled by the Republicans, right? What do they run on? Cut spending, absolutely. So what do they want to do? They're going to cut spending, find ways that they can cut. But if they cut from the nutrition title and SNAP, and try to find crop insurance, or if there's a big push to fund more for the nutrition title, where are they going to pull those funds from? Yet to be seen. Compromise, I think, is really what we're going to see play out. It's a costly bill, divided government. There has to be compromise at the end of the day. L2 sides, we've kind of talked a little bit of this as we've gone through supply chain, inflation support. Well, it affects everybody. I don't care from what state you're at, what demographic, what industry, and inflation is there. It'll be targeted to read from both sides, Senate and House, and come to some agreement there. The biggest one I think we'll see, loggerheads, nutrition. Senate has been quoted, Senate Ag Committee people of one increase. The administration has been quoted wanting increased funding for a nutrition side of it. I think someone here at this table, Mr. Ellenberger, said, hey, you're probably like you're going to see cuts and reforms in the House. Where do you meet in the middle? Where's that bottom line figure end up? Crop insurance. A lot of people just say, hey, it's working okay. Let's just let it be status quo, let it be. Don't monkey with it a whole lot. However, I think it's on the table probably at some level. If we're looking at cuts and how to reduce expense in some segments of the Farm Bill, I think what we talked about. Key legislators we talked about, Debbie Stabenow and Don Bozeman will lead the Senate side, and Lynn Thompson and Dave Scott on the House side. I think this has been out there that both the Senate have announced that they're not running for re-election in 2024. So if this is their last chance to get something that they wish to be in the Farm Bill, maybe more willing to compromise and put the name on it. We're going to skip through that. I think this one is very key in terms of the State Department of Agriculture. Now it's its top 10 priority list. Animal disease up top. if we have another round of avian influenza, swine disease breakout, pet and mouse disease, we've seen that how that plays out to the ag sector. Definitely need some more funding to go that way to keep those programs funded and prepare ourselves for any kind of negativity down the road. This slide. Partisan divides, I think in government, truth itself, we see that a lot of times, especially in the news, the newspapers, it's always Republican versus Democrat, there's always some kind of loggerheads in play to where who gives? At some level, where they see any kind of resolution to the farm bill where it's passed this year or it's just extended with the 18th provision, don't know. But I think there will be some attempt based on those, the chair of those committees, those senators and congressmen, women, they're on a committee to sit down and come up with some kind of agreement in terms of getting something passed that's good for the American ag sector. Last one here, just quotes from G.D. Thompson and his view in terms of conservation and climate, that I think we're getting close on time. So I'll open up for a few questions. And then if none, then I think Howard and the staff and Chris will be around here for a little bit at the end if you want to chat.
What's your take on ARC and PLC? Those get retained in some fashion?
I think they get retained in some fashion, and I'm talking to most of the crop insurance folks that we deal with, that it really is not going to be much change from last year. It's not going to pay a whole lot in terms of income, so let it be the same as you had, and you're probably fine. Gene, you okay? Good to go. Good to go. Hey, on behalf of the Haldeman team and Chris Showman, appreciate you guys coming out here this evening. Hopefully it's worthwhile. You gained something. I know I gained something from both of these guys here. I have to argue with you a little bit, Howard. You said that you saved the best two for last. I don't know. I think you did a really good job in terms of talking about land values. So with that, thank you.